Big trouble in little banks. Bailout sparks buying panic in bonds, Bitcoin and gold bullion. Tyler Durden of Zero Hedge reports. The Federal Reserve, FDIC, stepped in and saved the world again last night, but nobody told regional banks, whose shares are down dramatically today. Admittedly off the lowest of the day, but all with multiple trading halts today. FRC, WAL, MYFW, the highest default risks banks, and the Russell 3000 bank sector, according to Bloomberg. But it's not just the small banks who are seeing default risk increase. All of the global majors are seeing CDS spreads rise. According to Bloomberg, Credit Suisse CDS has never closed higher and is now more than double the risk than the peak of the financial crisis, with the regional bank index continuing to crash land. After the year of hiking rates and hawkish Fed speak, the Federal Reserve, it all took to tighten financial conditions drastically with open-ended facility to bail out the financial system. Bloomberg's financial condition index tightened massively overnight. And again, according to Bloomberg, the market has completely blown up any hopes that the Federal Reserve had for a hawkish path from here, with the terminal rate plunging and significant rate cuts being priced in. For context, the market expected over 110 base points of rate hikes by September on Wednesday, but it now believes that by September rates will be over 65 base points lower, in the words of Virgin Mary, come again. Now, for context, today was the biggest gain in the third ED contract since 1987. The shift in the market's expectations for the Federal Reserve rate trajectory is simply stunning. Stocks rallied after the bailout, but we note that the U.S. majors were unable to get back to the pre-SVB, that's Silicon Valley Bank, fail levels. Small caps, heavy with financials, have been clubbed like a baby seal. And obviously, financials were the biggest losers. On the flip side, only defensives were bid. Credit markets blew out today on the spread basis, exceeding the shift in equity risk. Bonds were aggressively bid across the curve, with short end and massive outperformer over the last 3 days. And the 2-year yield is down almost 100 base points in the last 3 days, dropping back below 4%, its lowest since September of 2022. Powell is officially Volcker. The seconds and tenths just steepened, and the fastest pace since the Volcker economic crematorium unleashed the worst recession since World War II. Short term, the decoupling between VIX and MOVE from late February is starting to unwind, but equity risk has a long way to go. As alternative currencies were sought as safe havens, sending Bitcoin soaring above 24,000, and gold spiked above 1,900. Oil prices puked overnight, with world WTI down to $72, handled before bouncing back. It started to slide again, ending lower by 3%. Finally, systemic risk indicators are starting to flash red, with FRAOIS spiking, and the global dollar liquidity is drying up fast. But Biden said the banking system was safe. If the Fed's backstop is so good and the banking system is so resilient, why are these systemic signals worsening? This is on Zero Hedge by Tyler Durden. Please leave your comments, and thank you for your support. Kindly support my Patreon account. The daily posts are 5 videos daily, and they are totally different from what I have on my YouTube channel. Thank you so much for your support, and that you find all my content so interesting. You'll find the Patreon account details in the description box.